Welcome to today's Explainer. I am absolutely thrilled to guide you through what I can really only describe as a modern biological classification of Wall Street's strangest specimens. We're taking a faux documentary look at the financial wilderness. You know, that place where the brightest minds, the guys with PhDs in quantum physics, and the guys who literally eat crayons, somehow collide. But as an explainer and a financial advisor, I'm not just here to laugh at the wildlife. We are here to actually analyze the extreme behavioral risks of each investing style, figure out which personality traits lead to the most catastrophic financial losses, and suggest professional strategies to mitigate these specific, deeply flawed human tendencies. All right, let's dive right in. I want to anchor this entire explainer on one sacred, absolutely hilarious truth that unites all of these completely clueless financial archetypes. Nobody knows what the hell is going on. Seriously. This is the baseline risk of the entire stock market. Every single investor profile we are about to look at is, in some way, just trying to cope with this exact uncertainty. Some do it through math, some do it through pure delusion, and some do it through sheer adrenaline. To keep us on track today, we're going to run through a structured field guide. We'll identify the boring traditionalists, the hustlers and chart artists, the digital degenerates, the apocalyptic doomer, and finally, wrap it up with one universal truth. Section 1. The boring traditionalists, or as you might know them, the Warren Buffett disciples. Now, from a professional advisor's perspective, this is our low volatility specimen. Honestly, their investing style is the human equivalent of watching paint dry. I mean, just picture their highly methodical nature, multiple shades of beige khakis, lukewarm coffee, spending 400 hours dissecting 10K reports. They literally will not shut up about economic moats, intrinsic value, and compound growth. And while thorough analysis is definitely a solid professional strategy, their massive behavioral trap is complete rigidity. They bring zero life to the party, and far more dangerously, they bring zero adaptability to a changing market. There is this hilarious, staggering gap between their ultra-patient philosophy and their actual lack of modern returns. If you ask them about their year-to-date return, they'll immediately get defensive and claim they invest for the long term. But the serious risk here is massive opportunity cost. By stubbornly clinging to outdated valuation metrics, they've been underperforming since the Bush administration. The professional mitigation strategy for this traditionalist, you have to force diversification into modern growth assets, rather than just letting them blindly cling to value traps. Moving on to Section 2, hustlers and chart artists. These guys are practically running on Red Bull. So we're transitioning now from those patient traditionalists over to the hyperactive degenerates. And this is where the financial risk absolutely skyrockets. Our first specimen calls himself an entrepreneur, but his so-called diversified income streams, they consist of sports betting, crypto meme coins, and charging people $20 to get into his party. From a risk management perspective, this is a 5-alarm fire. He isn't trying to beat the market, he's just trying to beat his pending DUI charges. His entire portfolio is just this toxic mix of high-risk gambling and a sketchy Forex trading course. The crucial takeaway here is that beneath the surface of his supposed self-improvement routine, there is zero actual financial strategy. He starts his day with a cold plunge, listens to a David Goggins podcast, and calls it meditation while thumping his chest, wishing he was back in 90s Wall Street. But in reality, he's aggressively running on empty Red Bull cans and a suspicious white powder he left on his nightstand. Listen, if this guy ever tells you the best investment is in yourself, run. The professional strategy to save him, he needs a complete behavioral reset. We have to replace the adrenaline of the hustle with disciplined, automated, passive index investing before his capital goes straight to zero. And that leads us right into a very closely related species, the chart artist. These folks completely ignore what a company actually does because to them, fundamentals are just for boomers stuck in the past. They don't care about revenue or debt at all. They only care about lines on a screen. Armed with 12 monitors, yes, 12, the chartist doesn't do due diligence. No, they do arts and crafts. They look at a stock chart the exact same way conspiracy theorists look at grainy UFO footage. They find bull flags in their morning coffee and draw Pablo Picasso-style art on graphs, genuinely believing every single candlestick tells a story. The immense risk here is trading purely on noise. Technical analysis without any fundamental grounding is incredibly dangerous. To mitigate this, a professional advisor would force the chartists to pair their technical entry points with actual, robust fundamental valuations. Section 3, the digital degenerates. We're talking Web3 bros and options traders. All right, prepare yourselves, because we are descending into the absolute madness of internet-bred traders. These specimens exhibit the personality traits that lead to the most severe, total, 100% financial losses. You track the spectacular boom and bust of the Discord-addicted crypto bro, and it's always the same story. He turns $400 into $13,000 and then rides it all the way back down to zero. He insists fiat currency is a scam and lives off-grid in a van while hypocritically relying entirely on his mom's Venmo account. Oh, and he hasn't filed taxes since 2021 because, the blockchain is borderless. What is truly terrifying here from a behavioral finance perspective is their coping mechanism. Instead of accepting financial ruin and analyzing their mistakes, they redefine massive losses, like getting your entire net worth rug pulled by a meme coin literally called fart coin, as an educational hurdle. They spend 8 hours a day in Twitter spaces arguing with 14-year-olds using fancy jargon they don't actually understand. The financial prescription for this? Strict, unwavering risk management protocols. We're talking enforcing stop-loss orders to prevent catastrophic capital destruction. Right next to them, basically in the digital gutter, is the options meme trader. This is a nocturnal creature who literally feels things instead of reading earnings reports. They worship Roaring Kitty, haven't seen daylight since the GameStop peak in 2021. They run entirely on Monster energy drinks and Hot Pockets. And get this, they view a devastating 40% portfolio pullback as a mere consolidation. They actually refer to their trading losses as literal battle scars. There is such a stark contrast between their immense delusion and reality. Their big generational wealth plan is gambling absolutely everything on weekly SPY call options, and when they inevitably expire worthless, what do? They blame invisible market manipulation. They call Warren Buffett a coward, and they absolutely refuse to learn what a Roth IRA even is. The professional mitigation for this personality type is urgent financial education. You have to redirect that gambling urge into a small, quarantined play money account while making sure the vast majority of their net worth is safely locked away in traditional retirement vehicles. Section 4. The Apocalyptic Doomer, a guy who is critically short of hope. For our final specimen, we're plunging into the dark, unblinking depths of a creature who had this twisted spiritual awakening after watching the movie The Big Short. 137. That is the exact number of times in a row this Excel-obsessed hermit has been wrong. He just paces around his apartment all day in his socks, mumbling about synthetic CDOs, calling literally every asset class, even non-tradable ones, a massive bubble. The behavioral risk here is total analysis paralysis. Missing out on years of compounding market growth because of a perma-bear mentality is honestly just as financially devastating as losing it all on a meme coin. I mean, he is short the market, short the economy, and just critically short on hope. His bunker setup is literally just water jugs, canned beans, and Q1 earnings reports from 2012. He is so patiently waiting for Western finance to fall just so he can stand in the ashes and whisper, "I told you so." As a financial advisor, mitigating this intense doomsday bias requires a phased dollar-cost averaging strategy. By automating their investments, we completely remove the emotional apocalyptic bias from the data, forcing them to participate in the market regardless of how the sky supposedly looks today. And finally, Section 5, one universal truth. Because nobody actually knows. So after cataloging all of these completely chaotic behavioral strategies, from extreme rigidity to degenerate gambling to just apocalyptic fear, what have we actually learned today? Whether you treat Warren Buffett's letters like holy scripture or you're out there betting your rent money on a ridiculous candlestick pattern called the inverted frog, what is the ultimate takeaway from observing this financial ecosystem? Absolutely nothing. The hilarious reality here is that the market remains a total mystery, and no matter which of these ridiculous personas you adopt, nobody actually has any idea what is going on. And honestly, that is exactly why broad diversification, automated risk management, and staying incredibly humble are the only true professional strategies to actually survive this wilderness. So which of these Wall Street specimens are you secretly guilty of being? Think about it and make absolutely sure you protect your portfolio from your own worst habits.